Hello. Can you people hear me? Hello, can you hear me? Can somebody hear me?
Yes.
Cool. Right, I'm sorry I'm late. I apologize. I don't like to be late. I really value people's time, and I apologize for being late. A bit disorganized. Just before we start, is Jordan on the call? No, okay. I was gonna say something to him. Okay, so let me just get my notes 1 second here. Let's get a bit disorganized. Okay, so there's a few things that I wanted to talk about. So I'll briefly, for a couple of minutes, talk about the new pick that I've made. Also, I'm sorry about the hours changing. It's just that I'm in kind of the UK, and we only change the hours at the end of the month, so it's kind of a bit of a confusion here. Anyway, so the new pick that I want to talk about is Lfmd. This is a pick that I'm very familiar with, sadly not for good reasons. I had a bad encounter with this business, but I don't get emotional investing. Things happen. Didn't work out at the time. But I would like to believe that I'm also becoming a better investor. Those are famous last words. I've made that assumption before, and everything is good and everyone is singing and dancing until they're not, and then so why I'm attracted so the reason why I'm attracted to Lfmd is that it's I know that if you look at the share price in 2021, man, it went to the moon and then it just utterly got demolished. But yeah, for whatever it's worth, the management team holds a substantial amount of stock. So for me, this is something that is very important because, I strongly believe in what Charlie Munger says, that if you show me the incentive, I'll show you the outcome. And if the management team has a lot of skin in the game, it gives you the likelihood they're highly motivated to do the right thing for the long-term shareholder. Now, that sentence is full of caveats. The likelihood. So if you sorry, someone has kind of got something in the background there. Sorry, I don't know who it is, if you can mute that sound. So when it comes to investing, there is no free lunch. Okay, so you're trying your hardest to get slightly more than 50% likelihood of your of your business doing well. Let's see who it is. Cannot see who it is. Might be you. Okay, we'll see how it goes if the sound is muted now. Okay. So when you're trying to invest, you need to do a couple of things. First and foremost, you need to see that the business has a strong balance sheet. With a weak balance sheet, you can have the best business in the world, but it's so difficult. And I come on these calls every Tuesday and I say the same thing. You don't need to do a lot. You spend a couple of minutes looking at the balance sheet and it will keep you out of so much trouble. If you have a business, it doesn't have to be with a net cash position. It doesn't have to be a debt-free business. If you have a business that has a reasonable balance sheet and the underlying business has a path to sustainably make free cash flows within the next 12 months or so, it just makes life easier. So what you're trying to do in investing is you're trying your hardest to position yourself in a scenario where the outcome is more likely than not going to be positive. And everyone's going to fail, like whether you're Buffett, whether you're Charlie Munger, doesn't matter. Everyone has, failures, and we're not them. So, but it's a game of odds. So you're just trying to shift a little bit the odds in your favor. So just to highlight why I like Lfmd, I like this business because it's a bit interesting. So they have two different businesses within that. They have the software business and they have the telehealth business, okay? Now, you might be surprised to know that the software business is actually causing a drag in the overall revenue growth rates. So the software business has very high gross margins, and it's making a lot of cash flows, and that cash flow can be used to then reinvest back into the business. But when you look at the growth rates of the business, the telehealth part, this is really GLP-1 kind of, pretty much is a play on GLP-1 really. That side of the business is growing at 90% year over year. It's extraordinarily fast growth, but the software side of the business is growing at about 15%. So on a consolidated basis, it's not growing that fast. It's growing, like last quarter we grew at 60%, but then you look at the prior Q4, it was at 0. So it's kind of growing, but it's like, it's not optically easy to see why it's growing so fast. But this is kind of the play that I had with 2 years ago with Palo Alto Networks, and I also more recently had with Broadcom. So you have the console. So investors typically like to focus on the top line, and they don't really spend too much energy. And I understand why. They don't want to spend too much energy focusing on the underlying drivers here. And I honestly also believe that when you get caught up in the weeds, more likely than not, it's not going to work out. Okay. So generally speaking, I will say, if you start to say, oh, but have you thought about this? Have you thought about that? That generally speaking, you've already lost the faith. Like it doesn't matter what you believe. The market needs to align with your line of thinking, right? So if you look at a business and you have to kind of deconstruct it slightly, unless that deconstruction is going to happen within the next 6 months, you need to just avoid that, because it's like, oh, if you just wait a little bit, like the market doesn't care about that. And you need people to recognize what you see, because I've been in the situation with, let's say, with this whole play with Antero Resources, like the kind of idea that you need more electricity. And if you're too early, that's the same as you being, wrong. So you need to be in a situation where the market is going to see what you see very rapidly. So I kind of waffled a bit too much on this, but I kind of wanted to just highlight as well that the underlying business of Lfmd is growing at about the profitability. I suspect the EBITDA figures will be up about 90% year over year when the year is out. So, it's kind of priced at about 15 times EBITDA. So if the business is growing really rapidly and you're not paying a large multiple, the odds are in your favor, provided that you have a strong balance sheet. Now, the first caveat for Lfmd, is this just a flash in the pan? And the big players like Eli Lilly or whatever are just going to corner this market? Are the generics going to come in place? So there's a lot of question marks here. And we can discuss this in a second when I kind of open this up for Q&A. But what is really important to think about is that you're not paying up for any growth here. This is not a growth story that I'm asking you say, oh, like think about this in a growth. It's like it's 15 times EBITDA. And lastly, before I just open it up, what I like about this business, it's kind of like a software business in a sense, or that's a bit of a lie. Let me rephrase that slightly. It's a very working capital negative business, because you, as a subscriber, come in and you pay them cash up front for the pills, the GLP-1 pills, the weight loss pills. You pay them cash up front and they'll send you that stuff over the next 2 or 3 months. So I like these businesses that are working capital negative. Obviously, the classic example of this is like something like Airbnb, where you kind of, you're prepaying. Anytime you're prepaying for something that will come later on, is really good, because the customer is funding your business models. I should probably come up with a better example than Airbnb. I don't know why I always think about that. I just know that Luke owns Airbnb, and I'm always, I was always thinking that's about my mind. Okay, so specifically about Lfmd, does anyone want to ask any questions? This is a good time. Remember, this is for you. We're doing these calls. So, ask your questions. And then after that, I'm going to ask you if you want to talk about maybe Moneyline or something else. So in the first instance, do you want to talk, anyone want to talk about Lfmd at all? Okay, nobody wants to talk about that. Would anyone like to talk about Moneyline or any of the stocks in the portfolio?
Yes, I want you to explain a little bit about GTLB just because it has been dropping so much and it's staying there now.
Yeah, fine. So this is GitLab. So when I make an investment in a company, I am trying my hardest to get the multiple that people will pay for that business in 12 months. And what drives the multiple is the confidence that people will have of the higher earnings power of that business. Buffett calls this owner earnings. I generally look at free cash flow. It's the same thing, really. Free cash flow is just basically the cash flow that the business does. It throws out. Are you familiar with free cash flow? Are you familiar with free cash flow? Not sure. So what I'm trying to do is trying to get the multiple that people will pay in next year. And when the results came out for GitLab, they essentially said that we're not going to be as profitable as we had been in the last 2 quarters. So they said, oh, we're going to have another year of reinvesting in our business. And the market will never like you for that. The market, generally speaking, wants you to start to make as much cash as possible now. And they essentially saying we're going to push that out by 12 months. So I made a mistake in recommending GitLab. I wish that it hadn't been the case, but ultimately I felt that they would be more profitable. Now, whenever I make an investment, the clock starts ticking against me because I need that to show a profit as soon as possible, and it clearly is not. It's a result. I've made a mistake here, and I will say to you, I generally believe that in 6 months' time things will be back okay. But for now, I recognize, particularly if you're not very familiar with my work, I recognize that you have you may have some lack of trust in what I'm trying to drive here. But I think that we're going to be okay. I really think that we're going to be okay here. But I recognize, I can understand how it's frustrating. The stock is down like 20% since I recommended it. And I will say also, to my defense, the market has, in the last couple of days, since Friday, has kind of taken a risk-off sentiment. But I'm not excusing myself, it hasn't performed as well as I hoped it did. I genuinely believe that I'll come back in 6 months and then we'll see how things are performing here. I have it as a hold and I'll just see how it goes for now. That's all I can say, really. Would you like to ask any other questions about it?
Yeah, so at this point, we should just hold, right?
Yeah.
Hold and see.
So exactly. So when I recommend a business, generally speaking, I like to give that business 12 months. So when I buy a stock, quote unquote, I'm underwriting that business for 12 months. After 12-month period, I'll say, okay, do I want to keep it longer a little bit? Are things starting to work out how I felt it would, or are things not working out? So after 12-month period, I'll say, okay, it's not working. Like, it's fine. I made a mistake. Off you go. That's why I always say equally weight the positions, because very often people fall in love with certain ideas, and if you're equally weighted, it's like a hurdle that stops you from falling in love with a certain stock. So it's a protection mechanism against yourself. Yeah, so let's see. It's not the end of the story. Let's just see how it goes. I'm always very transparent. I always say, you know, exactly what I think, and I'll tell you straight away. You know, if it's not working, I'll say like, okay, but just give it like another 2 quarters. Like, what is that? So they just reported Q4. So let's give it until Q2 of this year, 2024, and then we'll kind of say how it goes. Okay.
Thanks.
Okay. Okay, so
sorry, change of subject a bit, but since I missed it before, quickly, I see about Lfmd in your latest article. Did I understand well that for the work simply the subscribers dropped, but the revenues increased? Is this did they just increase the price or something?
Yeah, correct. Yeah.
Okay, so is it a problematic that they're losing subscribers? Would it
So,
long term?
Throughout 2023, they had said that they were going to spin off this business. It's because obviously you can understand it's like they got this health side of the business and then they got this software side of the business. So it's like the market doesn't generally reward with a high premium these kind of conglomerate-like businesses. They're like pure plays. And management is very open. If you read back through the earnings calls of throughout 2023, they'll tell you, like, we understand that we're considering spinning it off or doing a partial spin-off. So when you do a partial spin-off, you spin off, let's say, 80% of the business, or even 20%, doesn't matter, a fraction, so that then that becomes a pure play DocuSign kind of like business. You get a premium on that, and then the market is better equipped to say, okay, your stock, that stub, that amount, a small amount of your business is priced at, let's say, 5 times sales. Therefore, we'll give 5 times sales to whatever's left of your business, of that PDF simply, and we'll take that away from the market cap, and whatever is left, that is the value of the telehealth business. But they also said on the call, if you read through the Q&A, they said that we are trying to stabilize those numbers. Once those user numbers stabilize and they kind of, let's say, flat year-over-year growth rates, it'll be much easier to do an IPO or something similar to sell off that business. But they need to have stable numbers, and if they believe, which I feel they do believe, that they'll stabilize that in this year, if you have stable numbers, man, the market will pay very nice for that type of business. Has I can't remember, I think it was 95% gross margins. I wrote it down. Let me just see this. Can't remember. I wrote this down. I think I wrote it down on the article itself, actually. Yeah, I think
growth rate.
It's around about 95% growth margin. Man, this is like fantastic. It's
yeah,
really,
90%. Yes.
Yeah, sorry.
So, but this means that that we expect, if this works out for them, we expect to at some point probably have like that they split in 2 different companies and we get a piece of each of them. Yeah,
that will be generally how it happens. They also have some kind of different partnerships on the sides. This is kind of like why, not often, but occasionally, these kind of hustler-like type management, you know, like this other company that I own, Uranium Energy Corp. It's like that Amir, I think his name is Amir, like these hustler CEOs, man, they always like with fingers on lots of different pies. So if you look at Lfmd, they got like they got some partnerships with MediHealth, I think it was called, or something like that. So there are kind of like little things happening on the sidelines. So there's the kind of the business that I'm interested in, which is the GLP-1 business, but there's kind of little add-ons on the side. So I feel that, you know, at less than approximately 500 million market cap, I think, you know, we should be okay. There's a lot of different ways this may work out.
Okay, thanks a lot.
Michael.
Hi.
Talking about UEC.
Yeah.
Did you, I'll clarify, did you just say that Amir, the CEO, is promotional?
Yes.
Yes.
The dude, man.
Well, don't you think that's a negative to the stock?
I genuinely don't care. Genuinely do not care. You look at Elon Musk, he's over promotional, man. He's never spent $1 on advertising and his company is doing just fine. You look at Palantir's CEO, these dudes, man, like, not even a firm CEO, man, these guys can spin anything. Like, for me, if those people have, so Amir, I think has about, I think it's approximately 30 million that he has of
35.
35, sorry, can't remember. So these people, they're highly motivated. So
Yeah.
as I said at the start of the call, if you show me the incentive, I'll show you the outcome. If you have like substantial ownership of a stock, you will do whatever it takes to see that the share price goes up over time. And kind of, I'm jumping around here, but with coming back to Lfmd, I kind of like this kind of idea that there's different things you can do because you're kind of still small and you can do interesting emerging sides of emerging segments, emerging kind of business units. And I kind of like that rather than a more kind of bit more slow kind of growth business, because it's kind of like difficult. Like IBM, they can have the best like operations under the cloud and infrastructure, but it's got so much corporate fat that it's kind of difficult for them to to really grow. Even if they're doing something well, it's kind of difficult. So I kind of like those businesses that have a lot of optionality that is not immediately obvious. Does that make sense?
Yes.
Okay. Does anyone else want to ask any more questions?
One more question on UEC.
Yeah.
Where do you get a up-to-date quote for uranium? What do you use?
Like I just look on trading economics, and that they have loads of stuff. It's a few days out. I know when I look on Twitter that they've always got the more updated ones, but from I'm kind of holding USD for a long time, so I don't need it to be kind of on the pulse straight away. Just need ballpark. It's not the best trading economics. It's okay. If you get it a few days late, it's like for my purposes, it's kind of okay.
Thank you.
I did have, Michael, I did have
Hi.
one question. Hi, yeah, I did have one question more on portfolio construction.
Yeah.
Not so much on individual selections, because I know the individual selections are probably a lot of it's probability bets. I noticed a lot of your much of your selections are more in the mid-size and small and even geared towards technology. Or is your approach pretty much a bottoms-up approach where you're looking for that deep inflection cash flow inflection, and if the general question is your portfolio of 15 to 20 stocks meant for a subscriber like me to be part of a larger portfolio, or is it a complete portfolio in itself for your subscribers to emulate? I'm not sure if I'm making sense, but hopefully I am.
Yeah. So basically, when I started the service, I had a dream that my dream was that people would just go equally weight all the positions and forget about it. Over time, I have learned that people don't want to do that. People want to come and pick one or two stocks that they kind of like the story more, and that's what they do. So this is my portfolio, like as in like this is all I have. But I know that generally speaking, people will just pick out one or two that they like and take that on. And I find that if the market is particularly strong as it has been, and the portfolio is doing better, they will feel more confident in my picks to pick out another one or two names. And conversely, when it's a risk-off sentiment, like it has been since Friday, people kind of get really nervous and they don't want to buy any more from the portfolio. So that's that first. That's the latter part of the question. Going back to the front of the question, so I'm agnostic to the size. So I recommended Broadcom last May. That has a market cap. Well, it had a market cap when I recommended. I think it was, I'll be lying exactly, but I think it was around 330 billion. And I think now it's around approximately 625. So since my recommendation, that is like a mega cap, and that is up. It was up 60%. I put it to a hold now. I will look to sell it at some point soon, and I've made that clear to everybody that you know I'm not buying any more of this. And I also recommended Meta, which is like I think top 3 or top 4 largest companies in the world. So I'm not really that focused, and I do not believe, for one instance, that just because something is small, it's undervalued. So many people think that just because something is small, no one's following it, they can buy the dip. Categorical nonsense, absolute nonsense. On the other side of the equation, I don't believe it just because Nvidia is like very followed and it's going to do well. Like, so you have to be very selective, really. I'd say if I was to really summarize what I do better than most people is that I'm very selective. I say no to a lot of stuff. So I'm not focused too much on mega cap, large cap, small cap. I'm going to where I think there is a mispricing. Often it happens to be in these kind of smaller businesses, but like I was with Palo Alto Networks until recently, and that's like it was 90 billion market cap. So it doesn't matter, to be honest, the size of the company. Does that answer your question?
Yes. Thank you. I appreciate it. Thank you.
Here's another question, Michael. When you exited Palo Alto, you already own Centennial One. Is that correct?
That is correct.
So if I own, if I had one of my biggest positions, CrowdStrike, you have no problem buying Centennial One and just holding CrowdStrike, because all the cybersecurity stocks have a habit of moving together.
They definitely move together in a period of 6 months. Absolutely. In a period of 6 months, they do move together. But you don't know when that 6 months of divergence happens. You know, there's no memo that goes around. And I've seen that, like, I'll give you an example, right? And I'm not like touting my own, like Palo Alto ended up as a failure. Well, kind of, let me just rephrase that. I did okay from when I bought it. I didn't get out of the top. But throughout that period that I owned it, including the sell-off day, so including that brutal day, it was doing quite well in terms of keeping up with CrowdStrike. But the CrowdStrike was a lot more volatile and kind of went down a lot and then went up a lot. Whereas Palo Alto was much more kind of boring, wasn't really kind of doing much, kind of just tickling up over time. So for me, that gives you more what I call pillow factor. You can sleep at night. You know, it's kind of, you don't get that buzz when it's going up, but you don't get that kind of negative cortisol when it's going down. So to answer your question about diversification, I typically have 20 stocks, kind of 18, 20. I don't really like having that many, but it just happened. I like to have about 16. I feel that's kind of better. And I'm working towards that to have each position will be 5%, just to kind of have a bit more concentration. But if you have, let's say, more than 20 stocks in your portfolio, you could very well do with having 2 cybersecurity names. But if you have less than that, you have to be very, very aware that you're making, as you described accurately, largely the same factor bet. Now, you don't know when that diverges. So it's kind of like that. You don't really know, but you need to be quite honest with yourself that what you're sticking with in terms of your holding period. Does that make sense? So if you're going to hold, let's say, I don't know your holding period, but let's say if you generally say, look in the mirror and say, okay, my holding is only around 6 months, just stick with CrowdStrike. If you think that it's longer than 6 months, if you're genuine honest with yourself, not like when the market is going up, but if you're just honest, look back over the years, is it more than 6 months? I would say it's okay to have the 2 stocks in the portfolio. Does that answer your question?
Yes, it does. Thank you.
Okay. Okay, would anyone else like to ask a question? Okay. I had some topics to talk about today. So I wanted to talk about discipline, and a lot of people come to the market when the market is hot, looking to make a quick buck. And they kind of like, oh, I've already seen people write to me saying, oh, my portfolio is up 30%, 40%, whatever. And I'm like, it's much better for your portfolio to go up by 15% per year. Let's say, for example, you're up, let's say 15% for year 1, 15% for year 2, 15% for year 3. At the end of those 3 years, you're up 50%, 50. But if you're up 50% 1 year and you're down 50% the next, and then you're up again 50%, you only are up about 13%. So it's much better to aim for stamina, for being able to drive a slightly less exciting portfolio that allows you to have what Woody Allen calls stick-to-itiveness, really sticking, something that allows you to stay through the permeations of the market, rather than something that, okay, everything's working out, like everyone's going to the moon. You need to be quite disciplined. A lot of people fall. The discipline is something that they think about after the fact. Oh, I should have, and I could have. And I say that investors kind of go through these two like pendulums of kind of being indecisive, like, oh, I'm at a loss, should I sell? Shall I buy more? And they have this FOMO, where they're kind of like, oh, look, CSMI, it's like going to the moon, blah, blah, blah. And, that type of investor isn't doing themselves justice, because we are in a very strong market right now. And I'm willing to bet that at the end of 2024, that investor will lose a larger portion of their money, because they'll in a bull market, everyone feels like a genius, but you need to invest with the preparation and the discipline for the downturn. You need to be always thinking about that, about how to really. So I like to talk about this investment because it's something that isn't working out that well, and I'm sorry to bore some people because I always mention this investment. So I recommend PayPal. Actually, Timos, you actually asked me this question a few weeks ago. It's like, oh, do I use stop losses? And when PayPal reported their results the next morning, everywhere, like it was just absolutely everywhere, PayPal gets slammed. Like everyone's like, oh my God, it's going down, it's gonna blow up and blah, blah. And I'm like, it's cool. Just stick with the strategy. Let time do its thing. Now, I recommended that PayPal at $55. It's now about 59, kind of touching on 60. It's kind of like an 8% return in a few months. It's not the best return in the world. I get that. But, if you're making 5 or 6% a year, that's already better than the average investor. The average investor makes 3% a year, okay? So if you have a dog like PayPal, and it's kind of like 8% in like 6 months, that's okay. So, but having a stop loss will force you to get out. So you need to, that's why I don't like having stop losses. I'll make the decision after 12 months whether I want to keep that business or not. I'm not letting the broker decide for me. The broker hasn't done the work. They haven't got up in the morning and looked at PayPal the way I have. Like you abdicating that. And that's why I generally like to give time the driving seat of the business. Very sorry, very, very sorry. And my connection dropped. Can you hear me? Can someone just, yeah, sorry. Sorry. Yeah, basically, it doesn't matter. I'm just saying that I don't like to use stop losses because I just feel like they give up too much of your power to the brokers. Okay, I kind of waffled on for such a long time. Does anyone else want to ask any questions? And otherwise, I'll just kind of wrap it up here. No one else? Well, okay. I'm really grateful for everyone to come, and I'm sorry about the drop at the end. You know, write me a message at some point if you have any questions that you want. I do these Tuesday calls for you. I'm really trying my best to explain the core principles of investing, because it doesn't matter if your strategy is different to mine. Doesn't matter. That, like, literally it makes no difference. But there are some principles that are so important to think about. You know, check to see the balance sheet. Couple of minutes, man. It's like you just a couple of minutes. Look there. Just check to see how stable the business is. You know, you don't want these flash in the pan like kind of things. Just try your best to just have some sense of conservatism when you project out. Finally, make it quite systematic, your approach, so that you're not falling in love with certain stocks. And yeah, I think that's all. Thank you again, everyone. Really appreciate you coming. Thank you.
Thank you.
Thank you, Michael.
Thank you,
Thank
so
you,
much.
Mike. Thank
See you
you.
next time.
Thanks a lot.
Bye.